this is a sequel to my previous episode whereby I disclose my preference on REITs that are now paying more than 10% in dividend yield. So if you want to check it out, look for links above and look towards the end of this tutorial because I'll leave it also for you to follow on and refine your own investment process. Today I'll be talking about this fantastic REIT, the best performer in the last 5 years, undoubtedly. This is none other than Parkwaylife REIT. Why is Parkwaylife REIT so good or so appealing? It's quite simple. You can see in the pictures over here that they own very appealing assets. What are they? Gleneagles Hospital, Mount E Hospital, and not just that, they also own Japanese nursing home. But Parkwaylife REIT has also seen a crash in their share price. And if you are curious as to whether this is an opportunity or not, you like my point of view, continue watching on. Hi guys, welcome back. Without further ado, let's get started. Parkwaylife REIT is really in an appealing sector because they are in healthcare. When it comes to tourism, when it's recession, of course tourism would take a hit. When it comes to recession, you also see retail malls doing less sales, you also see offices possibly also struggling. But for healthcare, it's day and shine. We also need healthcare. That is why if you see in their performance over here, you realize that they make monies from 3 main hospitals that I'm sure if you are staying in Singapore, you know about them. Mount Elizabeth, Gleneagles and Parkway East. Parkway East is the smallest, but Gleneagles and Mount E actually are big components. Take note again, this is 2015-2016 chart. And I got this snapshot in because I want to show you the growth in terms of what is achieved in the last 6-7 years. But to understand growth, you also need to understand they have also a master lease with Parkway Hospital Singapore. This master lease is 20 years running, and not just that, it gives you an embedded escalation rate when it comes to the rent collected. They have a formula over there with a minimum of 1% escalation. Rain or shine, that's the minimum you get. That is why if you compare the 2015 one to the latest 2021 statement, you see that Mount E, Gleneagles and Parkway East have all registered an increment in net property income. Wow, so this is a cash cow, correct? These 3 hospitals are definitely known and they're definitely going to be there in the next 10 years or so. So they signed 20-year lease and then there's an escalation every year. Worst years, 1%. Better years, CPI goes up, more percentage increment. And as we know, Singapore is a medical tourism hub. Wealthy individuals from Middle East and Indonesia come to Singapore to look for healthcare. But okay, if you see the snapshot of net property income NPI, you realize that it has actually declined, correct, year on year by 2.9%. So who is the dragger over there? It's none other than Japanese portfolio. Actually, Parkwaylife REIT has invested in Japan ever since 2008. So they are not a newbie in Japan at all. They've been building that asset base. They've identified Japan as a big addressable market many years ago, and that has been its fuel for growth. So this decline in net property income, could it be due to the drop in Japanese yen? Because as you can see, Japanese yen has tumbled massively, correct? But is this decline in Japanese yen a temporary one or a permanent one? It really depends on your interpretation. If it's a temporary one, it's quite obviously an opportunity. In any case, do note, from first half 2022, Parkwaylife REIT's Japanese exposure is 82% hedged already. But that's not my worry. My biggest worry is actually Japan being the growth driver is slowly crept up of its weight in Parkwaylife REIT, which means to me the risk profile has changed for the last 14 years. Previously, when I buy Parkwaylife REIT, it's definitely in these 3 Singapore hospitals. Right now, it still is. It's just that the Japan weightage has been growing bigger and bigger. And right now, Japan's contribution is about 40% already. An example can be seen in this recent acquisition by Parkwaylife REIT in September 2022, whereby they've actually made a purchase of 3 nursing homes in Hokkaido for about 26 million Sing dollars. So this acquisition is actually yield accretive because the average net property yield is about 6.5%, and there's a natural hedge because the loan is taken in Japanese yen. These properties have actually a long lease expiry and therefore they'll be a very stable contributor to the portfolio itself. So the big question is, can Japan continue to be a reliable growth driver now? Because in Singapore, there aren't that many growth opportunities. Of course, Parkwaylife REIT has a first right of refusal, ROFR, on Mount E Novena. Mount E Novena is a popular place right now for deliveries. I have a lot of private clients there who delivered their babies over there. But as of right now, that is still not in the portfolio itself. So that is the first big concern that I'd like to highlight to you. But there's also a second concern, and that's none other than its low dividend yield rate, correct? Right now, Parkwaylife REIT is actually the lowest payer in terms of dividends, clocking in at only 3.82%, whereas the industry average for REITs right now is 8% already. Of course, this 8% is skewed up because of US office REITs. But 3.82% is really pathetic in today's interest rate climate. You realize that T-bills and Singapore savings bonds are paying 3.7%, thereabouts already. Therefore, 3.82% is not risk-free and is definitely low as compared to those assets. If you compare to offices in Singapore, you realize that CICT pays about 6%, Suntec REIT pays 6+%. And all in all, these could be factors as to why healthcare is also a sold down asset class in US itself. You'll see over here that healthcare real estate sector declined the most for third quarter 2022. This is mirrored against the Singapore one, whereby Parkwaylife REIT has underperformed Mapletree Industrial Trust for comparison, which owns data centers in US, and CICT, which is the biggest REIT we have here, owning offices and malls. Everybody has declined with a higher interest rate environment, but the decline seems to be the steepest for Parkwaylife REIT, and my concern is that if Parkwaylife REIT needs to get to a 5% yield rate easily, could this decline persist at least for the next few quarters ahead? Now, since you stuck with me to here, I've actually a bonus point and my rounding take on things. Parkwaylife REIT has been a steady dividend payer. They've in fact grown their dividends ever since IPO, so this is fantastic. A very stable asset class. It's just that in current interest rate environment, I think it probably needs to deliver 5% in terms of dividend yield for it to be attractive. Does that mean that Parkwaylife REIT could decline further? Again, that's up to your interpretation, and this is not a buy or sell recommendation. They are a good company, they are a good REIT. It's just that in current environment, it seems like more dividend yield is needed. Then how about exploring other healthcare stocks such as Abbott? Or how about Merck, who is one of the first few to produce a COVID-19 antiviral medicine? Or how about Pfizer, who is number 14 on my top 30 stocks to invest for 20 years? Now, this video is sponsored by Weibo, and if you would like to buy US stocks, or if you want to buy S&P 500 ETF, you can actually use Weibo because they have $0 in commissions. I'm a user of the platform, and as you can see over here, the user interface is very simple to use. Not just that, right now Weibo has a special promotion. In total, $150 worth of cash vouchers. Simply use my links below, deposit $2,000 to start your account, and do your first stock trade. Thank you for supporting this channel. Use my referral codes below, and let's dive back to our tutorial. Then my question to Parkwaylife REIT is, could they increase their dividend payout ratio a bit? Because right now, they are earning about 16+ in terms of earnings per share. Could they squeeze out a bit more dividends and pay probably 15+ so the dividend yield bumps up faster towards their 5% rate? That is my take on it, and that's why I'm still on the fence for Parkwaylife REIT in current environment. I'll keep track of them, and as always, if you have questions and thoughts, leave in the comment sections. And if you have benefited already, help me smash the like button because it will help us reach a bigger audience together. And as always, if you would like to invest better in REITs, check out my previous tutorials. This touches on Mapletree Industrial Trust, and this touches on US commercial REITs. So if you haven't seen either of these tutorials, check them out also, and maybe they can help you refine your own investment process. I'll see you there too. Take care as always. Goodbye.